Hello and welcome to another video as part of the technical analysis series. It's yet another update to one of the originals. Today we're discussing horizontal support and resistance. So here's the outline for this video. Disclaimer first, then we'll cover the broader question of does technical analysis work and what that term entails. We'll then go over the important point that charting is not trading and kind of the limited scope of the material we're going to cover. We'll define the term levels and go through some of these price action variants of it. We'll talk about how to identify levels, some nuances that I've picked up over time, quickly gloss over the types of setups that you may get at levels, and then we'll conclude. First things first, usual disclaimer, pause the video, familiarize yourself, all of that. I am an idiot, I'm not a financial advisor, not an investment advisor, not a lawyer. Nobody you should listen to, frankly. Trading sucks, you'll lose all your money, I'm a clown, clueless, this is for entertainment purposes only, get some help, and so on and so forth. But if you do stick around, make sure to like the video and subscribe to the channel and do all the stuff that has supported me so much over the last 5 years. Thank you for sticking around with the technical analysis series, always a work in progress, so let's get straight into it. Now, the broader question of does technical analysis work? It's quite interesting to be addressing that premise maybe 5 years after the series came out, but I do have some thoughts on this. Broadly speaking, it's a popular question, but it's terribly phrased. I feel like I'm that Jordan Peterson meme where it's like, what do you mean by does? What do you mean by technical? What do you mean by analysis? What do you mean by work? But like, as memey as that is a fairly decent framework to engage the question. If you do answer yes, which I do, because it's sort of how I trade, obviously, I think even the answer yes exists on a spectrum. So you have like, on the extremely strong side of yes, you'll have the premise that price charts contain all necessary information, public and private, to make accurate predictions about future prices, or sometimes even stronger forms of kind of determinism. So for example, for these advocates, everything you might ever need to know is in the price, whatever news release is coming up is priced in, even sort of unexpected events and things that weren't public information and sort of shocks when it comes to news catalysts, those were priced in by the chart as well. So that's like a very strong form of technical analysis adherence. And on the other side of the spectrum, the extremely weak version is something along the lines of the market isn't completely random and some prices appear to be stickier and more important than other prices in a way that can be predictive. I'm much closer to the somewhere between, close to the extremely weak part for sure. And I think for TA to be valuable, the claim doesn't need to be particularly great in terms of it'll tell you what the market's going to do, or claims about its strike rate and everything else. I think the basic observation that the market isn't completely random and that some prices appear to matter more than others in some sort of replicable way that you can model, that's sort of enough to have a baseline to work on something, in my opinion. So why might technical analysis be useful? There are a few reasons. The first, I'm sure you've heard this argument before, essentially the self-fulfilling prophecy argument that, look, in a retail-oriented market, we're all kind of looking at the same stuff, the same levels, using the same tools, and therefore there will be much overlap when it comes to flows and positioning and how the market participants react to certain shifts in price. Some other explanations that you can find in financial literature is stuff like order herding, and herding just like you would sheep, so kind of very similar mechanism of participants clustering around the same price points. There's also order splitting, which is to say that a lot of the time when you get big moves, there are outstanding orders that remain unfilled at those levels. So when the market comes back to those levels, you get some sort of reaction as the remainder of those orders are filled, or if those underwater positions choose to cut their exposure at the place where they got them, or vice versa. That phenomenon is also decently well recorded. We also have stop market order clustering. So we'll talk a lot about spiky SFP, failed breakout type of setups. And again, this is something that's been written about a lot and is fairly well established in literature, that stop orders tend to herd and cluster around specific prices, and the one-sided demand for liquidity that they create is quite replicable and predictable, at least to some extent, enough to be useful at the very least. Again, a lot of these concepts were covered in the market microstructure video, which you've hopefully watched. If you haven't, go back and do that. This will all make a lot more sense. And the last point, which is somewhat more crypto specific, is that crypto fundamentals are largely, or a lot of the time, depending on the project or protocol, whatever else, in one form or another, informed by price. There we go. So analyzing price makes sense. fundamentals equals price, price equals fundamentals. You get this reflexive flywheel type of effect where number go up, fundamental metrics better, that's bullish, number go up, fundamental metrics better, price bullish, so on and so forth. So it makes sense to have price as one of the things you look at, and that's in essence what technical analysis is. Now, if you want to be really cynical at that point, you could make the argument that there are no fundamentals and the market is just perception and liquidity and momentum, but even if that's true, looking at prices still seems like a worthwhile endeavor, so why not do it, or at least have a baseline understanding? I think that's another broader point I didn't really include here, but when you consider sort of technical trading, it's not that you either have to trade entirely based on TA or you have to think it's complete nonsense, right? You can have a weighted approach in your trading system of how much importance you ascribe to technical levels, and that percentage doesn't need to be terribly high, but I think some portion of it is not a complete waste of time. How's that for an endorsement? Now, this is an important point, and it's something I wish I had learnt earlier, back when I was trying to paper trade and spent all day drawing levels instead of actually trading the market. And that's kind of the central point there, right? Mapping a market is not the same as trading it. So identifying levels at most gives you a broad understanding of where you might look to do business. So that's kind of one facet of trade identification, but that's all. Just being able to draw on a chart, and even if the market does something, quote unquote, at the levels that you've drawn, that doesn't inherently, or far from it, build the foundations of a trading system. It doesn't inherently tell you anything about risk management, sizing, entry triggers, exit triggers, trade management, what assets you choose, and all the sort of nuts and bolts that make up a real trading system. It's just one small part of it, which is kind of trade identification, or broadly points you towards where you might want to do business, and then the rest is for you to figure out. Just drawing on a chart does not do that for you. Live trading, back testing, ideally live testing, journaling, refining setups, those are kind of your tools when it comes to translating the line on your trading view into something actionable, replicable, and something that eventually morphs into a system. So don't fall into this complacency trap where you're correctly, quote unquote, identifying the pivots, but if you don't have a way of approaching the market and actually putting that or translating those views into trade ideas, then it's a very limited use to us, right? And that's why the bullet point there says spend more time thinking about the boring stuff in order to succeed. And also, just I guess there's a basic intellectual exercise here that it's no surprise you can go on Twitter and just get levels off really good traders or people who've been doing this for a while, but that doesn't guarantee profitability, and there's a reason for that, right? Or even you can have traders at the same levels but will approach the market completely differently and even have diverging views at times. That's where the edge is, not just in the mapping of the market. So let's get into some definitions. So when it comes to defining levels, the definition presented here is a level is a price or cluster of prices that has either acted as a floor and or ceiling in the past or preceded a large move. Now, this is a very broad sort of all-encompassing price action definition for the stuff that we draw on our charts that we hope has some sort of significance. Colloquially speaking, it's basically the premise that price action in this area doesn't immediately appear to be random, and or the market really seems to give a shit about what happens here. There's like a basic eye test that you can apply to the chart a lot of the time and kind of see the areas that seem to matter more than others. Now, the issue is a lot of technical analysis gurus have taken this simple premise and repackaged it in 100 different ways. So you'll see people trade levels, ranges, clusters, supply, demand, blocks, pivots, this, that, and the other, and you might think, oh my god, there's so many, price action concepts I need to learn to be well equipped with, naked trading, as the term is known, oddly enough. But that's not true. For the most part, all of these end up converging in the same place. They're all very similar, and we're all looking at the same charts, and the areas you'll get from, and even the exact levels you'll get from all of these trading systems, the overlap there is enormous. You can put a range trader, a supply-demand trader, an order block trader, whatever, in, at the same chart, and there's a decently high probability that you'll get more or less the same levels. At the very least, you'll be in the same neighborhood, if not exactly the same prices. There's no massive gap between these things. We're all looking at the same thing. Here's the candlestick chart. What levels seem to matter more than most, and how do we delineate them? So, if you're sort of intimidated by, the amount of sort of vocabulary that concerns this part of trading, don't be, because all roads lead to Rome, as the saying goes. Now, what are some basic identifiers when it comes to defining levels? We'll go over this in more detail, but there are 5 that immediately come to mind. And again, they're not mutually exclusive. There's overlap there, and I'm sure I missed a couple, but these are sort of the building blocks. So the first one is the peak of a rally. So you have a move up. Where did that peak take place. You delineate that either just with a line, with a wick, candle body, the candle itself, whatever, and that gives you some idea of resistance, right? The bottom of a dump, same there. You have also recurring, areas of recurring tests and bounces. Again, eye test kind of stuff. The prices that the market seems to care about and be attracted to and responding well to. And then you also have consolidations that can be contextually quite important. So what's the consolidation formed between large impulsive moves? Those areas can be pivotal. And the consolidations preceding impulsive moves. You kind of see a big move in the market and you track it back and think, where did that come from? And that's sort of where a lot of supply-demand logic comes from, right? And so before we jump into some diagrams, well, actually, let's do that first, right? So we had 4 or 5 categories here: peak of a rally, bottom of a dump, area of recurring tests and bounces, consolidations formed between impulsive moves, and consolidations preceding impulsive moves. This is 4 of them, but the consolidations thing does need to be split into 2. Sort of simplest explanation is the following. Top left is your classic. You have a rally, peak of a rally, market went down, you mark out where that peak took place, and we'll talk about wicks versus bodies and all that stuff, but it doesn't matter. If you're unsure, just box out the whole candle and you'll have an idea, but that's kind of your basic area of resistance. That's where the ceiling was for price at that moment in time, and we flip that on its head. That's where we get our understanding of support. It's where the market was dumping and then it stopped dumping, and something happened at that point for the reversal to take place, and that point may be interesting in the future, and so we've sort of drawn the floor for present purposes. This is in the bottom left corner. That's the sort of consolidation structure. We have an impulsive move, then price goes sideways, another impulsive move. That little consolidation post-impulse tends to be quite pivotal, or at least important from a structural point of view. So we're interested in the type of participation that went on there. And also, it doesn't have to be between impulsive moves. If you have like a range and then the market just breaks out from it, as I said, you kind of trace back and think, wow, this was a big move that made a higher high, shifted market structure. Something went on there to push price beyond its usual range. Where did that originate? And you kind of trace back and you find the supply zone, the demand zone level, whatever it may be, right? And then the last box is your classic kind of price-sensitive support resistance level, kind of very self-evident inflection points in the market, where support turns to resistance, resistance to support, or it sort of pivots one way or another depending on whether the market is above it or below it. Okay, those are kind of our basic structures, and you should be rather familiar with them at this point. Now, when it comes to identifying levels, you have no idea what you're doing. There is a kind of basic heuristic technique you can employ to at least land you in the right areas. And you can do some of these, you can do all of them, whatever helps. So you can say, where did a big move start? So you're kind of looking at the big outsized move, the big candles, and then you trace them back. And then you mark wherever the origin of that big move is. Then you can say, where did a big move pause before continuing, right? So you have an impulsive move, a period of consolidation, and another impulsive move. It's that middle of the sandwich, that period of consolidation, that may be interesting to us from a levels point of view. So you want to mark that. Where did a big move stop and reverse? So that's the classic sort of either range high, range low, support, resistance example. We want to be aware of where the big inflection points in the market have been so that we can follow them in the future. And then in terms of approaching this, you could simply start from very obvious higher timeframes like the monthly and weekly. And if you want to, work your way down to lower timeframes like your daily and intraday. And naturally, the areas where you'll have confluence, so you've got a monthly level there, a weekly level there, and there's just a lot of overlap from a top-down point of view when it comes to timeframes. You know that you're dealing with a higher probability area that's probably worth doing business, so sort of a multi-timeframe level. Now, sometimes a market will only have a few clear structures, and that's completely fine. So you'll see a lot of the time with beginners, when they'll show you what their charts look like, they've got a level every $10. Now, that's not very practical. Like, even if you had to trade that and you took a basic level-to-level approach, it'd be practically impossible. It also assumes that all of those prices are meaningful enough or significant enough to risk your capital, which just on its face is very unlikely, especially if your chart is completely covered and has no empty space. So if you have fewer levels, that's fine. That means the trades will be more obvious. And in general, when it comes to outcomes, more visibility and more higher time frame confluence generally lead to a higher probability that the area is good. So don't be dismayed if you start marking up a chart and you think, hey, I've done my homework from the monthly to the daily to the intraday. And there are a few intraday levels here or there, but there are really sort of 3 to 4 big zones that I think overlap and look good. That's completely fine, completely normal. And if anything, it takes away a lot of the decision fatigue when it comes to trading the market because you know exactly where to do business and you're not caught flat-footed when it gets there because you know it's obvious and you've been waiting for it. And sort of by definition, most of the time the market is not in an area worth trading, especially when it comes to kind of higher time frame swing trading setups. And the last point here is still something I try to stick to this day, is that especially after a bit of practice, most levels should just jump out at you. If you're there trying to get really surgical and thinking, oh, is this area good or not, and it's not entirely clear to you, and you're like drilling down and turning your monitor around trying to figure out if it's an area worth paying attention to, it probably isn't. The best, that there's a positive correlation between the visibility of the level and the likelihood that it's important and does well. So if you're there forcing the issue, then it's probably not as important as you think. And so again, these were sort of our baseline diagrams, and we can go over what some of these look like. So this is Bitcoin dollar at 19K. This is your straightforward support structure. As you'll recall, it's the bottom of a dump, bullet point number 2 from the basic identifiers. You had a very sharp move down from 30 to 20. That was the bottom of the dump, but before the first meaningful bounce, and that was our range low for quite some time, until recently, as you can tell. A similar point on this Chainlink dollar chart in terms of range high, or just resistance, or the peak of a rally, where you have like a very significant rally. It peaked here, and then was resistance again, and was resistance once again. So again, look how outstanding, sort of standout-ish these levels are compared to everything else. It sort of should jump out at you even without the demarcation on the screen. When it comes to those consolidations that form between impulsive moves, this is one on Polygon. You see like a huge rally and big break in market structure here. And the first time the market actually slowed down for a couple of weeks, or for a month in this case, was this consolidation before shooting off to make new highs. And that's like a very, very big move. That's a log chart, I think. And so when the market pulled back, it was this pre-breakout consolidation that ended up acting as support also. And then an example of the flip support resistance pivot type of thing. This is the 1200 level on ETH. Was previously the range high, ton of support, ton of resistance here, broke out, went up a lot, came down, that's where it found support, broke up again, and that's sort of where the market is churning and chopping at the moment. Now there is another type of level trading to be aware of, and it comes, and well, there are really two subcategories. One is time-based levels, and the other is sort of round numbers of psychological levels. So time-based levels are mostly self-explanatory. It's stuff like your monthly open, your weekly open, the daily open, and these things, I've seen the argument made that they're indicative of just higher time frame flows. I don't think that claim is true without context, but they do help you build a picture of how the high time frame candles may be developing as they're developing, right? And so they can act as pivots in the context of a higher time frame view. So for example, take a bearish daily bias, say yesterday was an engulfing, or the market moved into resistance, whatever it may be. Price trades above the daily open early on and then gets smacked down below it. And so as that is happening, because you've got that bearish daily bias and then price is below the daily open, in your head the daily candle looks like maybe it set its wick when it went above the daily open, so the wick of the daily candle, and now that it's below, now we get the body phase of the daily candle, right? So it can give you some sense of how these candles are forming. I wouldn't just blindly apply the sort of methodology of, oh, it's below the monthly open, it's bearish, above the monthly open, it's bullish, and so on. That sometimes can be useful, but I think if you have a contextual view on the higher timeframes that you can build and use the opens as a trigger, sort of where's the wick versus where's the body, that may be useful. So that's one thing to be aware of, especially if you have a lot of overlap and confluence between otherwise good horizontal support resistance structure, and then you have some sort of high time frame open there that contextually makes sense. That's the type of confluence that can really help in your trading. And then the other one is, of course, the standard just round numbers type of thing. Stuff that looks nice, 30K, 20K, $1,000, $1, etc. Especially when you're trending very hard and there's an absence of historical levels or momentum is ruling the whole thing. You'll see these used or front run or traded into for profit taking, mini stop runs, whatever it may be. So again, if you have, it's one of those things where maybe trading them completely on their own isn't super comfortable, but especially if you've got some confluence or overlap there with your standard tools, it may just be helpful. There are a lot of nuances when it comes to levels. I've written down some of them here. Just very quickly, with a lot of my other videos, I just feel like they're too long, and the presentation wasn't where I want it to be. I want these to be much more digestible. And again, frankly, this topic is so big and difficult, given this is my bread and butter of trading for 5+ years. I probably, if I want to do it justice, I probably have to do it in a multi-part series and address specific stuff, as opposed to try to cram it into 1 hour-and-a-half video. So hopefully this is short enough and interesting enough to give you a foundation that's engaging, at least make you think in the sort of in an interesting way, or in a way that sort of helps you develop your own trading system. And then if you want to get into the weeds, we can do that on stream or in separate videos or whatever, wherever else. So this is why the nuances, normally these would be their own kind of categories or sections, but I said, fuck it, let's just throw them in here, give you the information, and I'm sure by now you're all intelligent enough to figure these things out. So let's go from the top. Broken support is expected to act as resistance, right? Standard support breaks is probably resistance, and resistance breaks is probably support. That's why support resistance flips take place. Again, watch the market microstructure video if you want some nuances as to why that works. Again, all the usual stuff about order splitting, order herding, and self-fulfilling prophecy there is true. There's also just like a basic positional explanation where if something was support, people were buying it, and if that breaks, if the market goes back there, unless those positions puked at a lower price, that's their kind of break-even point or close to their break-even point. So if they were buying support, they were invalidated, and the market comes back up, they can get out at the price that they bought, so you naturally see some selling pressure there, right? Now, in terms of time frame hierarchies, I do have a video on time frames. You should watch it. All the videos are somewhat complementary, but in general, same rules apply. The higher time frame structures will typically give you bigger moves, and lower time frame structures will typically give you smaller moves. And the same consideration doesn't apply just to the size of the move, but the time as well. So higher time frame structure, you should give more time to unfold, retest, and so on, and you should be more willing to cut and be aggressive from a time management point of view when it comes to lower time frame structures. Like, I've seen a lot of people try to trade weekly levels, and they'll look at it for 1 hour and say, oh, that reaction is too terrible, it didn't move immediately, it's a bad level. And then 1 or 2 weeks later, it does exactly what they thought it would do, and it looks easy and perfect. So the issue there is you sort of have to judge a level by its own time frame. If I gave you an hourly level and there were 2 hourly candles on it, and then the move came, you'd think, yeah, that's completely reasonable. If I gave you a weekly level and it had 2 candles on it and it moved, you might think, yeah, it's completely reasonable, but most people don't, because they start viewing those higher time frame levels exclusively through a low time frame lens. Now, that can be a useful exercise if you're trying to get your entry triggers nailed down, or if you want to scalp the level before swing trading it and whatnot. But you kind of have to, the safe and reasonable thing to do, as far as you can, is to judge the level on its own time frame merits. Almost like a number of candlesticks type of approach, or just letting it play out on the time frame that it comes from. That's an important one. Now, next point is that recurring tests from the same direction generally make the level weaker. So if you have continuous bounces of support, that demand is getting soaked up there every single time, and until it eventually breaks and there are no buyers willing to rebuy at that level. And again, even just if you don't like the supply-demand explanation, which is strange because it makes so much sense, you could also just view it in terms of market mechanics. Like, if this support level were so good, why are the bounces so weak, and why does the market keep coming back to it? Right, so whichever explanation you prefer, if you're getting recurring and sort of back-to-back tests of a level from the same direction, so it's always being hammered as support, and it doesn't really leave that area, and it just keeps getting hit, that level gets weaker. And the same applies for resistance. If you have a level of resistance, it keeps getting hit, and you're sort of making higher lows into it, and the bounces are weaker each time, you don't want to trade that the 8th time around. So more tests from the same direction equals weaker level. A note on breakouts, which is something that's important when it comes to level trading, is that the best breakouts move quickly away from the level and allow little to no time to retest. And so the logical corollary of that is that stalling after a big breakout is generally a red flag, and that increases the likelihood that it's a trap. Because what you want to see on a breakout is a real sign of imbalance, right? You want to see participants get really aggressive, create a one-sided demand for liquidity, and the market having to travel much higher to satisfy those demands for liquidity, and that's how you get your big moves, right? Take like a bullish breakout. The standard microstructure mechanics there would be you would have shorts covering, which would turn into orders to buy, and you would also have fresh buyers ideally stepping in for the breakout momentum continuation trade. And so you've got buyers in the form of sellers closing, you have buyers in the form of buyers buying, and you have it all happening around the same price point. So the demands for liquidity at that point, because you're a buyer, you need to have a seller. You have a lot of buyers who want sellers at the same price, and if the market's really strong and that force is overwhelming and sellers aren't willing to step in close to that point, then the price just has to travel as high as it has to travel until those market orders are filled. And so if a breakout is genuine and it's quote unquote overwhelming or aggressive or is accepted, whatever terms you want to use, you want to see it stick. The opposite, of course, is true, where if you see a breakout and it doesn't go anywhere, that does suggest that those aggressive buyers are being sort of soaked up by passive sellers or limit orders or whatever it may be, and that's much more of a red flag. So again, all of this is covered in detail in the market microstructure video, but the best breakouts move quickly and allow little to no time to retest. If they do retest, you want to see it soaked up immediately and ideally only visible on lower time frames. The only exception to the retesting, and again, there's a whole retests video, which I strongly recommend, that's sort of acceptable in that regard, is if it comes back much later. So it breaks out and fucking disappears and goes up a lot, goes down a lot, and then after time and space comes back to retest, that's good. But something that just breaks and stalls, always be careful, right? And sort of the next point follows on from that, which is when buying a test of a structure, the first test or fresh test is typically the best test, or your highest probability trade from a sort of swing trade point of view at the very least. Next point, reclaimed levels become support resistance once again, i.e. when the support resistance flips fail, the original structure is restored. What I mean by that is the following. This should be familiar to you. Let's do it in TradingView. So say you've got a level of support here. The market bounces off that. That's your support. It breaks and does whatever it has to do. When or if the market reclaims that level, right, and trades above it, closes above it, whatever it may be, even though when it was broken, you expect it to be resistance, as soon as this original level is reclaimed, you treat it as support once again. So the reclaim kind of flips the switch, right? You can think about it in resistance terms as well, where this is your level of resistance, you know, that's the market finding resistance. If it breaks, you might be thinking, oh, well, I'm expecting this to be support until proven otherwise. But then as soon as it fails and it's accepted back within the original level, then you have to restore its original form, which is it is a level of resistance. So on the break, you can assume a flip, but if the flip fails, it restores its original function, be that support or resistance, depending on which direction it's coming from. In terms of trend and flows and other confluence factors, I think broadly speaking, the general stuff applies, which is to say that in an uptrend, you generally expect support to hold and resistance to break. In a downtrend, the opposite is true, where you expect resistance to hold and support to break. Additionally, when it comes to breakouts and trend, that's a really important one and a very difficult lesson for a lot of people in 2022, as if there was a shortage of those. But in an uptrend, there's a higher likelihood that the breakouts stick because they're in line with the trend, and a lower likelihood that the breakdowns stick because they're more likely to be traps. And obviously, the opposite is true as well. In a downtrend, you're expecting that breakdowns, which are moves in tandem with the trend, stick, and that breakouts are more likely to be traps. So in a trend, you generally expect price and delta to sort of follow each other. So if you're trending up and price is up and buyers are strong, etc., the likelihood that that's a trap is much lower, right? So there are some trend-based considerations when it comes to these things. And then to the eternal question of wicks versus bodies, the answer is yes, no, both, maybe. So for me personally, I mean, obviously, like, experiment with this, see what works for you, and so on and so forth. From my experience, if I'm playing like spike trap type of setups, I'll use wicks for my levels and to delineate the extreme if I think there's some sort of failed breakout or specifically stop run type of setup, or kind of wick to wick. If I want to narrow down the actual level or structure that I think is going to be the basis for reversal, I'll use candle bodies, because that gives me a smaller zone to work with, and I can be more precise in how I place my orders. When it comes to, and yeah, my personal preference is the one stated, and for you, just test and find out. We'll just use both. To be honest, if you're a beginner and you just want to mark up some charts, what you can do is just get that top candle, bottom candle, or consolidation candle and just box out the whole thing, and then see which areas price is sensitive to, see what timeframes you're using most, what makes the most sense, and sort of refine from there. There's no secret sauce there, really. It's not like, oh, I was drawing candle bodies and I started drawing candle wicks and I suddenly became a god trader profitable, all else equal. That's probably not going to be one of your top concerns. Now, what types of setups can we get at levels? Now, I was very reluctant to do this part of the video because I was thinking, oh shit, man, like I could probably make a separate video for each one of these. But again, I want to provide you with a foundation, and then maybe we can talk about it elsewhere or make follow-up videos. And that's why I need your comments. Please leave a comment on what you want to see, which bits were helpful, which bits were too long, too short. Anything from you is greatly appreciated. I want to learn as well, and we can make more of these. Not that we have anything better to do anyway. So in terms of types of setups, there's sort of 5 that come to mind, and they're not mutually exclusive by any means. There's a lot of crossover between them, but this is just some ways that you can start thinking about trading those things on your chart. So the first is just typical sort of same way level, which is that resistance is resistance until proven otherwise, support is support until proven otherwise, and this is very common in range-bound environments. So the example that comes to mind is, the BTC and Link ones. So, support is support, and you trade the level the same way as before. So this is support here, market caused the bounce, support here, market caused the bounce, and so on and so forth. So you're trading it the same way every single time, and the same with Link here. So you have top, that's resistance. You're trading this level the same way, which is down as resistance, same way down as resistance. Contextually speaking, this is very common in range-bound environments where your expectations of a breakout are low, and you're just going to assume the structures will remain intact until proven otherwise. The opposite of that, of course, is breakout trading. The basic premise there is price broke resistance, therefore the market's likely to move higher. Price broke support, therefore the market's likely to move lower. And this is kind of a standard momentum trade to some extent of you're trying to catch the shift from a balanced into an imbalanced environment. And that's sort of a lot of bread and butter when it comes to trading markets more broadly. And with that, you also have flips, right? And also, if you want examples of breakouts and stuff, I mean, Bitcoin in a downtrend has been pretty good at that. Specifically, the one that comes to mind is the 30K breakdown, right? When I say breakout, I just mean from consolidation. It could be up or down. I do use those interchangeably, but whatever else. Like 30K is a big example of that. ETH has a similar one when this sort of 2700 level broke down, and then it's kind of down only since there. So there's kind of your higher time frame momentum trades of, look, this is a big level, the big level broke, we're probably going to go up a lot or down a lot from there, depending on whether it's support, resistance, or support, right? When it comes to flips, that's another type of setup, which is the price broke resistance, as we discussed. If that level is retested, it's likely to flip to support. And then if price broke support, if that level is retested, it's likely to flip to resistance. And this is your kind of standard support resistance flip, which you see a lot in both breakout trading and also trend continuation type of setups. Some obvious one here, well, for example, for BNB, this is a same way level, which is the bottom of the range. That's where you found the bottom of the next range. And then in terms of support resistance flip, you have support, breakdown. Took a while, come back to retest, and that's sort of the area where it got stuck. The cousin, if you will, of that type of setup, or at least closer maybe to breakouts, is the premise of deviations or failed breakouts and those types of patterns. And the logic there is that breakouts should be bullish, and when bullish patterns fail, that's bearish. In other terms, if a breakout isn't accepted, the market's likely to go down, and the same goes the other way around, of course, which is where breakdowns should be bearish. When the bearish patterns fail, that's bullish. If the breakdown wasn't accepted, that means the market's likely going to go the other way, which in this case is up. And you see this all over the place, especially in range-bound environments, but it's just a good setup in general. When the market attempts to move from balance to imbalance and isn't accepted, it'll likely trade back where it came from. The classic example, and something we talked about at length on all sorts of newsletter, show, podcast thing, is the Bitcoin failed breakout at 45K. This is when the Lunar Foundation Guard was buying Bitcoin. You had a big level of resistance here, almost like a triple top. Market broke above it. It should be bullish, and instead it closed back below. This ended up being the excess, and the rest is history, as they say. Spikes. Now, this is sort of very similar to deviations of failed breakouts, just kind of delineated differently. So this is where you see your swing failure pattern, failed breakout, stop run type of amalgamation. And the basic idea is if you have a key high or key low, and you're assuming that that's going to be used for stop market orders, be it stop losses or breakout trades, and the market spikes and moves back below key swing high, those buyers who stepped in above that swing high are now offside, and the market's likely to move against them, which is down. Or the opposite example, if the market spikes below a key swing low, a lot of people are going to get bearish that, either to break down momentum trade or to stop out of their longs. And, if the market doesn't follow through, it's likely to move against those positions, i.e. in the upwards direction. Do I have spike examples? Probably not. But you can look at these anywhere. Big swing points. I think ETH near its top had something that looked a bit spiky, but in terms of timeframes, you can use this all the way from like the 5-minute to much higher time frame type of stuff. So this is, especially in crypto, these sorts of spike setups are all over the place on all time frames, so your eye should be trained to them quite well, and the larger the time frame, the better the setup. But honestly, in crypto, that's one of those that works on any time frame, and also used by scalpers and intraday traders, whatever it may be, right? So those are the four, like basically the 4 or 5 types of setups when it comes to trading levels. Same way, usually in a range bound environment. Breakouts, which is that, hey, stuff is shifting and we're through a big level, I expect a big move. Flips, which is this area was significant as support, and now that it's broken, it may be significant as resistance, and vice versa. Deviations and failed breakouts, which is to say when you have the market make an attempt at momentum, and that attempt gets soaked up or isn't accepted, it's probably going to move in the other direction. And then spikes is your classic sort of quote-unquote stop hunting or attempted breakout trading phenomenon, where the market will trade through areas where there's presumably clustered stop market orders, be that to break out or to stop out of position, and then reverse upon reaching that target. So to conclude, this video isn't comprehensive. As I've said, each subtopic could probably warrant its own video. I just really thought it was about time to update this horizontal SR video, because it's like 4 years old, and this is what I've been trading for 5 years, and I think it needed a bit of a facelift. It's a very, very difficult video to make, because striking the balance between making it like 5 hours and every little nitty-gritty thing versus something you'll actually watch, hopefully I got it right. Again, please let me know in the comments. As you hopefully have picked up, mapping levels is simple, trading them is difficult, and building a robust trading system around them is even more difficult, and that's really where most of your time should be going. Price action trading has evolved a lot over the years, and with that come new trends and rebrands and repackaging. I'll just suggest to you, don't get lost in the price action trading vernacular. This stuff is mostly straightforward, and then a lot of it is just sort of repackaging and giving you different names for the same thing. So the more important version is how these things work and being able to identify and trade them, more so than why or what exactly they're called and all that type of stuff. And if you want the why, just go watch the market microstructure video, because that's got a lot of stuff, and a lot of color in general can be derived from my other videos, the market microstructure one, market structure one, retests one, first trouble area. All of that is based around levels, so a lot of the stuff content you're maybe thinking I should have covered exists in those videos. And I guess as a final aside, I've been trading levels for 5+ years, and I'm still learning and figuring out nuances every day, week, month, whatever it may be. There's always something more to learn, and the way you do that is by experimenting, testing, journaling, and ideally doing so, even if it's with small size or less than 1% of your account, in a live environment where you're actually at the desk and you give a shit. So consider that as well. That's all from me. Thank you for watching. Thank you for all your support on the technical analysis series over the last 5 years. There's more to come. So subscribe, like, share. Please comment. Let me know what you thought. If you prefer this format or you want something much longer, much shorter, whatever. Hope you're all doing okay, and I'll see you for the next one much sooner rather than later. Take care.